Have you ever bought something online from another country? Or maybe you swapped cash for a vacation? Well, if you have, you've actually taken part in the world's largest financial market, Forex. It's short for foreign exchange, and today we're going to break it all down: what it is, how it works, and what makes the whole thing tick.
I mean, seriously, think about it. The price of your morning coffee is pretty stable, right? But the value of, say, the US dollar compared to the Japanese yen, that's in constant motion. And that nonstop dance of currency values, well, that's the very engine of the entire Forex market.
All right, so what does it actually mean to trade Forex? Let's dive right in and get down to the absolute basics. At its heart, every single Forex trade is basically a swap. You're not just buying one currency. You are always simultaneously selling another one to pay for it. It's kind of like a seesaw. When you push one side up, the other has to go down. You're always dealing with a pair.
So let's take a look at the most traded pair on the planet, the euro versus the US dollar. The first one, the euro, that's what we call the base. That's the currency you're betting on. The second one, the dollar, is the quote. That's what you're using to make the bet. So if you buy this pair, you're essentially saying, I think the euro is going to get stronger against the dollar.
And here's the goal of the whole thing. If you're right, and the euro does get stronger, you can swap it back and end up with more dollars than you started with. Simple as that. But if you're wrong, and the euro gets weaker instead, well, you take a loss. It all comes down to trying to predict which way that seesaw is going to tilt.
Okay, so we know what a trade is, but where does all this happen? You see, the Forex market isn't some building on Wall Street. Nope, it's something way, way bigger.
For one thing, this market practically never sleeps. It's like a global relay race of money. It kicks off Monday morning in Sydney and just keeps on running nonstop until the whistle blows on Friday afternoon in New York. And how is that even possible? Well, it's a completely decentralized global market. Just as the trading day is winding down in Asia, things are just getting started in Europe. And as Europe starts to close, the US is firing up. There is always a major financial center open for business somewhere in the world. All this constant around-the-world activity creates something called high liquidity. Now, what that means in plain English is that there are so many buyers and sellers that there's pretty much always someone on the other side of your trade. And this is huge for traders because it means you can buy or sell almost instantly. Okay, so we know what Forex is and we know how the market works. But what's the deal with the prices? What actually makes these currency values jump up and down all day?
So what are these traders staring at on their screens all day? It's a mix of big economic signals. We're talking about things like a central bank's decision on interest rates, a surprise inflation report, new job numbers, and, of course, any big political news that could shake things up.
At the end of the day, all these different data points are really just clues to one big question: how healthy is a country's economy? A strong, growing economy tends to attract investment from all over the world, and that increases the demand for its currency, pushing its value higher. So that brings us to our last section. How do traders actually try to make sense of all this information? And maybe more importantly, what are the tools and the risks that come with the territory?
Generally, traders look at the market through two different lenses. You've got technical analysis, which is kind of like being a chart detective, looking for patterns in past price movements to guess what might happen next. Then there's macroeconomic analysis, which is more like being an investigative journalist, focusing on all those economic health reports we just talked about. The truth is, most successful traders learn to use both.
Now, there's a really powerful and unique tool in Forex trading called leverage. Basically, it's like getting a short-term loan from your broker that lets you control a much larger position than you could with just your own money. It allows you to turn a small amount of capital into a really big footprint in the market. And here's why that's so attractive. You know, a tiny 1-cent move in a currency pair might not seem like a big deal. But when you apply leverage, that tiny move gets amplified, potentially turning a little ripple into a huge wave of profit. But, and you have to hear this, this is the most important but in all of trading. It's a double-edged sword. Just as powerfully as leverage can amplify your gains, it will magnify your losses. A small move against you can wipe out your capital fast. And that is why, in the world of trading, risk management isn't just a good idea. It is a survival skill. Without a very disciplined plan to protect your money, the exact same tool that creates so much opportunity can lead to disaster. So what's the bottom line here?
Successful trading isn't about making wild guesses and getting lucky. It's a discipline. It takes understanding the big picture, having a clear strategy, and most important of all, treating risk management like it's your number one job. And that really leaves us with one final thought. In a market that is always moving, driven by global events that unfold every single second, the real challenge isn't just about reacting to the chaos. It's about learning how to see the patterns hidden inside all of that noise.